Welcome to our most recent blog. I'm going to talk a little bit about what's happened in markets over the past few months, and tell you what we've done well and what's done hasn't worked so well for us, and then go on to outline again our thoughts of the market over the midterm. As you've all seen, markets have been very strong recently, and we've been talking a lot about. We've had a very positive view, as you know, over the past few months, and I think some of the things that we've talked about are now starting to be reflected in share prices. Principally growth, and certainly from the emerging world, and even from the more developed economies, has been much more robust, much more vigorous than many have expected. But much more important than that is corporate sector profit growth has again beaten all expectations. And if I told you 6 months ago we thought profits growth was going to be 40%, you would have laughed, and profits this year will grow 40%. So the economy is growing faster than many thought, and the corporate sector is generating much higher returns again than many have expected. So far within that context we've had a very good year. What's really helped us is above all our emphasis on best quality companies. So our big winners this year have been in position companies like Assa Abloy, Legrand, SGS, Amadeus, Edenred, Beek, Software AG, Swatch has done very well, and LVMH. On the disappointing side, some of our positions in the banks haven't acted quite as well as we expected. On the positive side, we've had great returns from Swedbank and KBC, but poorer, more disappointing from our other positions. So where are we now? We're still very positive, and believe that the outlook hasn't really begun to be fully reflected yet. As I said, the economy continues to be very vibrant. We're on the road meeting companies, we see this, and it's the reality. It's very different to what a number of economists are expecting or talking about, but on the ground the reality is economic growth is buoyant, and particularly from the emerging world, but also from the beginning in the developing world. The corporate sector, as I said, in every meeting we have with managers are fanatical about cutting costs and squeezing returns. Coupled with that, most company management teams are very worried about the future, so they've been extremely parsimonious on capital investment, and it's a very profitable cocktail. We're now by the end of this year we'll have returns on capital and margins which are very similar to where they were before the crisis took hold in 2007. So the corporate sector is really in extremely good, in a very good state. I mean, it's interesting now if you look at the balance sheets and the debt structure of most of our companies. It looks like the balance sheet after a boom period, not after a bust. So companies are in good shape. The big question mark, of course, is austerity and the possible impact that can have on economies. We have a slightly more optimistic slant than many others. We think the private sector will fill the role which the state has so far been crowding out the private sector. We also think policymakers will do whatever they can to drive economic growth, and debt deflation is the principal enemy, and whatever can be done to avoid that will be, whether it means printing more money, has been considered now. Also, in terms of interest rates, as you know, interest rates are still very low, and we think they'll continue to be low for some time, as policymakers drive hard to stimulate some economic growth. But aside from all of this, which we think is a pretty reasonable economic backdrop, valuations are still very compelling. Under 10 times, which is as cheap as they've been for the last 20 or 30 years, 10 times earnings. And of course, most equities now, equity markets, equities are valued more as cheaply against bonds and cash as they ever have been, certainly since I've done this job, and much longer. I think aside from that, in terms of one last comment on economy, I think it's fair to say the opportunities we think are probably more still in the northern region of Europe and less so in the south. We think, austerity will have some impact, particularly on the domestic economy in some of the more stretched countries like Greece and Portugal, and we think the opportunities there are more limited. Whereas, of course, in the north, Germany in particular and France, which have been paragons of fiscal virtue, we see both great opportunities on the domestic and on the, in particular on the export side. And of course, the weakness of the euro is getting another further big boost to those northern European and very efficient and competitive economies. The shape of our funds is very much the same as when we last spoke. Greatest emphasis on high quality growth. We still have our old favourites like Aster Abloy, LVMH, Amadeus. New positions include Pandora, the jeweller. We also have a large exposure to the banking sector through UBS, Swiss Re. We also own some of the credit banks, the regional credit banks like Banco Popular and Credit Agricole, and other positions quite diverse. Principal one to comment on perhaps is Fiat, the automobile producer, which we still think is tremendous value, particularly with the demerger of the company coming up. So conclusion, very positive outlook. We can remain fully invested and shape the fund similar to where it has been in the past. Thank you.